Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
Quick question for you. Imagine the cost of raising, say, $500 million in debt for your company.
Okay.
Now, picture that cost suddenly jumping, like 200 basis points overnight.
Wow. Yeah. That's significant.
And here's the kicker. Nothing about your company changed. Your plans are still solid. But one thing did, your credit rating.
Right.
That's the kind of tangible, immediate impact we're diving into today.
It really is a fundamental truth in finance, isn't it? Whether you're, knee-deep in treasury ops or maybe crunching numbers in FP&A.
Or even investor relations.
Exactly. Or shaping external perceptions in IR. Understanding corporate credit ratings, what they are, who issues them, why they're just non-negotiable for your financial strategy. It's critical.
Absolutely. So for this deep dive, our mission really is to peel back the layers. How do credit ratings actually work? How do they shape a company's financial strategy, its flexibility, and maybe most crucially, how do the leading companies actively manage these ratings?
Proactively, yeah.
To protect their access to capital, scope their future, we're here to pull out those essential nuggets of knowledge, give you a serious shortcut.
Sounds good. So let's start at the absolute beginning. What is a credit rating?
Physics.
At its core, it's an independent assessment, a view on a company's creditworthiness.
Like a report card.
Yeah, pretty much. Think of it as a report card on how likely that company is to meet its financial obligations, specifically repaying its debt.
Okay. And these aren't just like random numbers. They come from specific agencies, right? Teams we all hear.
That's right. They're assigned by a select group, the major players. Moody's, Standard & Poor's, or S&P, as most people say.
The S&P?
And Fitch ratings. And it's fascinating how they assign these grades, AAA, BBB, even down to B+ meth. It's based on a real deep dive into financial health.
So what are they actually looking at?
Well, it's pretty comprehensive. They're not just looking at one thing. They scrutinize the stability of your cash flow, your leverage ratios, coverage ratios, how much debt you have versus earnings.
Standard stuff, but crucial.
Crucial, plus the inherent risks within your specific industry. And even, the softer stuff like governance and your stated financial policy, it's a holistic view.
And the ripple effect, once that rating is out there.
Oh, it's immediate and widespread. They directly influence the interest rates companies pay on their bonds. Lower rating means higher borrowing costs, full stop.
Makes sense.
And they shape how investors see your company, signaling risk or stability. And yes, that perception, it can definitely nudge your stock price too.
It's like a public trust score, almost, with very real financial consequences.
Exactly. Which brings us nicely to this key distinction, this kind of line in the sand in corporate credit, investment grade versus high yield.
Or junk, as it's sometimes called.
Yeah, often bluntly called junk. Investment grade is the, let's say, safer side of that line. These are firms rated BBB or higher by S&P and Fitch.
Or BA3 from Moody's.
Right, BA3 or higher from Moody's. They're seen as lower risk, so they attract the more conservative investors. Think big pension funds, insurance companies.
They often have mandates, right? They have to invest in IG.
Precisely. Mandates often restrict them to investment-grade assets. And that's where dropping below that threshold, falling into high-yield territory.
That's the chasm you mentioned.
It really is. It triggers a massive shift. Who can buy your debt changes, and crucially, what you have to pay for, it skyrockets. These high-yield firms pay significantly higher interest to compensate investors for that added risk.
But it's more than just higher rates, isn't it?
Oh, absolutely. And this is often overlooked. A downgrade, especially falling into junk, can trigger covenant violations on your existing debt.
Meaning you could suddenly be in breach of your loan terms.
Exactly, requiring immediate, often painful action. And it can severely limit your access to new capital right when you might need it most. It's like having your credit card limit slashed without warning.
Wow. So, okay, this isn't just a niche concern for the debt team or the treasury folks then?
Not at all.
It sounds like your credit rating actually permeates major decisions across the whole company.
Yeah.
Capital structure, M&A plans, even dividend policy.
Absolutely, 100%. The implications are far broader than just the cost of your next bond deal.
Okay.
If we connect this to the bigger strategic picture,
Right.
yes, lower ratings mean higher interest costs, but think about equity pricing. A downgrade can signal increased risk to the whole market.
And investors get nervous. stocks might sell off.
Potentially, yeah.
Oh.
And think about day-to-day operations, too. Those essential liquidity tools, credit lines, commercial paper facilities.
Uh-huh. The short-term stuff?
Yeah, that can simply dry up for companies with poor ratings. So imagine an economic downturn or some unexpected challenge hits.
Right when you need cash most.
Exactly. That lower rating doesn't just make things more expensive, it can actually sever those lifelines. It severely limits your financial flexibility or options precisely when you need them.
Which really hammers home the point, I guess. If you're, say, in FP&A, modeling a new factory, or running scenarios for a big acquisition,
You have to factor this in.
you have to ask, how might this affect our credit profile?
Absolutely. It's not just a treasury thing, it's a strategic imperative.
Yeah.
Every finance leader needs to have this on their radar because it shapes the real cost, the art of the possible for your plans.
Okay, let's make this concrete. Let's talk about some real-world examples. Companies navigating these rating shifts. Ford comes to mind.
Ford, yeah, that was a big one.
That,
Back in 2020, they got downgraded to junk status, both Moody's and S&P.
ouch, why?
It was driven by rising debt levels and also declining margins at the time. Tough spot for them.
And the impact.
Pretty immediate. A noticeable jump in their borrowing costs, obviously, but also severely limited access to those stable, cheaper investment-grade bond markets.
So what did their finance teams do?
They had to pivot hard, aggressively towards liquidity preservation. That meant making tough calls, like cutting dividends, raising capital through shorter-term, probably more expensive facilities, just to shore things up.
Shows how quickly things can change, even for a huge name.
Definitely. And then there's Kraft Heinz, another big name, different story, but similar outcome.
They fell into non-investment grade too, right around 2019.
That's right. After earnings declined and their leverage stayed stubbornly high, it was largely a hangover from that big merger they did.
So the merger integration didn't go smoothly, financially speaking.
Well, the debt load remained very high relative to earnings. That downgrade significantly increased their cost of capital, put immense pressure on them.
What kind of pressure?
It essentially forced them into a multi-year deleveraging plan. They had to prioritize paying down debt, often painfully, over other strategic things like maybe more M&A or investments.
So the very thing meant for growth, the merger, indirectly led to a period of contraction or focus purely on debt.
In a way, yes. It really highlights how critical managing the credit profile through a major transaction like a merger is. If you don't, it can backfire and force a painful pivot.
Okay, but it's not always about falling, right? Some companies climb up the ratings ladder.
Netflix.
Yeah, a fantastic example of the opposite journey. For years, they were almost the poster child for a high-yield issuer, funding all that content growth with debt.
Exactly, mountains of debt. But then something shifted. In 2022, they finally earned their first investment-grade rating. S&P and Moody's both upgraded them.
What changed?
They started consistently generating positive free cash flow. It showed real financial maturity, that the business model was working sustainably.
Any upgrade impact?
Lower cost of borrowing, obviously, which for a company that had relied so heavily on debt, that's huge. It signaled a whole new phase of financial maturity, a big vote of confidence from the agencies.
Interesting. And Tesla? Similar kind of journey from risky to more stable.
Somewhat similar trajectory, yeah.
Hmm.
For many years, Tesla operated with a junk bond rating, somewhere around B+ add, I think.
Why so low initially?
Well, early stage risk, you know. Scaling up manufacturing is expensive, volatile earnings, the usual challenges for a company growing that fast in a new space.
But they turned a corner.
They did. As Tesla achieved consistent profitability, started generating much stronger cash flow, around 2022-2023, the agency started actively considering upgrades.
Reflecting the improved fundamentals.
Precisely. It's a great example of a company moving from being perceived as quite speculative to becoming a financial powerhouse, and the rating eventually catching up to that reality.
And then you have the giants at the top, like Apple. They're not AAA, but close.
Very close. Apple maintains top-tier ratings. AA+ from S&P, AA1 from Moody's, just one notch below that perfect AAA.
But they have tons of cash. Why do they even issue debt?
That's what's remarkable. They do issue debt, often quite a bit, to fund share buybacks, dividends.
Okay.
But here's the key. They do it while meticulously managing their balance sheet to preserve that top-tier rating. Their treasury and finance teams, laser-focused on leverage discipline, predictable free cash flow.
So it's not just about saving a few basis points on interest for them.
It's much bigger than that. It's about signaling absolute rock-solid creditworthiness. That underpins investor confidence globally, and it gives them unparalleled financial flexibility. They can do basically anything they want, whenever they want, financially speaking.
Okay, so it's crystal clear. Companies don't just, sit back and wait for their rating. They actively manage it.
Oh, absolutely. It's not passive at all. It's a proactive, strategic endeavor.
So what are some of those key strategies? How do finance teams actually do this?
Well, first and foremost, maintaining conservative leverage. That's huge.
Meaning keeping debt levels in check.
Exactly. They often aim to keep key ratios, like debt to EBITDA, below specific thresholds. For instance, staying under, say, 3 times is often a target for firms aiming for a solid BBB rating. It's a clear line they try not to cross.
Okay. What else?
Strong interest coverage. Agencies really dig into this, your EBIT to interest expense ratio. Having coverage north of maybe 4 times is generally seen as quite favorable, shows you can comfortably pay your interest.
Makes sense. And liquidity, having cash on hand.
Absolutely critical. Robust liquidity management, having ample cash reserves, undrawn credit lines. It's not just good housekeeping, it's a vital buffer. It improves resilience and really reassures the rating agencies.
Anything else? Maybe less about the numbers.
Yes, definitely. Fostering an open dialogue with the rating agencies. This is often underestimated.
Talking to them regularly.
Yes. Investor relations and treasury teams meet with them regularly. Not just when there's bad news, importantly. They proactively explain their strategy, their financial forecasts, address potential concerns head-on before they become big issues.
Building trust and transparency.
That's the goal.
Yeah.
And here's one that really shows how central ratings are. Adjusting capital allocation. Meaning it's not uncommon for firms to actually delay things they might otherwise want to do, like big share buybacks, or even postponing an acquisition if doing so would jeopardize their target credit rating.
Wow. So they'll change major strategic moves to protect the rating.
It happens. It truly demonstrates that ratings aren't just an outcome, they're an input into major strategic decisions, not just some line item on a report.
Okay, so let's wrap this up. What are the big strategic takeaways here for every finance leader listening, regardless of their specific role?
Well, first, I'd say remember that credit ratings aren't static. They're not fixed. They are dynamic.
Living things.
Living reflections, exactly, that move right along with your company's strategy and performance. They evolve.
And their impact is broad, way beyond just the cost of debt.
Far-reaching. We talked about interest costs, market access, but they can affect vendor terms, how your employee stock options are valued. It really touches almost every corner of the business in some way.
Which means managing your rating. It needs to be baked into the process, right?
Absolutely. It needs to be a fundamental, embedded part of your financial planning cycle, integrated into strategy discussions, not an afterthought dealt with only by Treasury.
It has to be part of the conversation for every major decision.
From the smallest capital allocation to the largest M&A deal, yes. Understanding the potential rating impact is crucial.
And ultimately, knowing how these agencies think, what factors they weigh most heavily, what really moves the needle for them.
That knowledge empowers you. It puts you in a much stronger, more informed position when you're at the decision-making table. Because, like we said at the start, credit ratings fundamentally shape the real cost and feasibility of your strategic choices.
Powerful summary. So maybe a final provocative thought to leave folks with.
Sure. Think about this. Credit ratings are, as we've said, this living reflection of financial health and strategic choices, a real-time barometer of market confidence. So as you look ahead, maybe consider what might the next major economic shift or industry disruption mean, even for companies that seem incredibly stable right now.
How will their rating dictate their path?
Exactly. How will their current credit rating, or a potential shift in it, dictate their path forward? Will it create massive challenges or perhaps unlock new opportunities? It really shapes their destiny in many ways.
That's a great point. So we'd encourage you, the listener, to think about how you might apply these insights.
Yeah.
Maybe by actively modeling with ratings in mind in your own work, or just by staying more attuned to news about company credit changes.
Don't just look at the stock price headline.
Right. Look for the underlying credit story, too. Thinking more like a credit analyst. It can help you and your company protect that vital access to capital.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.